Let's ask our headliner today, Liz Ann Sonders, Chief Investment Strategist for Charles Schwab. Welcome back. It's nice to see you.
Nice to see you too, Scott. Thank you.
How about this volatility, which is renewed, it feels like? Is it directly related, do you think, to the Powell probe?
It's hard to isolate things in the immediate aftermath of that. You did not see a reaction in the market. Maybe it's a little bit of a delayed reaction, but it could just be a pause period after what have been pretty robust rotations happening under the surface. So I don't think it looks to be anything terribly alarming right now. This is just the nature of the beast.
How does the market look to you as we begin the year? Pretty well.
It does. The broadening out trade, I think, has legs, and that's inclusive of international equities, small caps, but I would stay up in quality in terms of small caps. I think you want to kind of fade the unprofitable segment of small caps and lean into the profitable. I think the equal weight outperformance has legs. You've seen a pretty significant shift into cyclical segments of the market, materials and industrials. I think that's the market telling you that the economic outlook is relatively healthy. And I think those trends have legs, not in a linear fashion. That doesn't mean every week, every month you're going to see outperformance across those cohorts. But I think it is a year where you would expect a continuation of more dispersion, lower correlations, and a playing field that is a little bit more level for active managers relative to passive.
I'd like you to listen to a soundbite from BlackRock's Rick Reeder, who was with me yesterday. If you recall, it was a few months ago. He called this one of the best investing environments, if not the best he's seen, and he doubled down. Let's listen. We can react on the other side.
I'll never forget the interview we had. We said this is the greatest investment environment I've ever seen. I still hold to that.
You do?
Yes, I think it's a great, but I think what you're going to see now is much more volatility.
Do you think this is a great environment, just given some of the things you said, the projections for where earnings are going to be, a run it hot, so to speak, economy into the midterm, animal spirits around M&A, deregulation, and the like?
Yeah, but I think it's going to be with fits and starts, specific to the inflation backdrop. We're already in a situation where the market is expecting the Fed may at least temporarily put itself in a timeout akin to what they did a little more than a year ago when they had launched an easing cycle, put themselves in a timeout because of tariff-related uncertainty, went back into an easing cycle. And now because really neither side of their dual mandate is suggesting they want to go full steam ahead with rate cuts, I think you could see some volatility. But I think what we're likely to see is a continued sort of churn and rotation kind of environment. It probably means that you need to be a little bit more nimble, but I do think it is more representative of what we used to think of as a stock pickers market. I think we shouldn't invest with a monolithic mindset. I think gone are the days you could just, bet on a cohort like the Mag 7. And I think we are in an environment where you're going to continue to see these rotations. And for the stock picker out there with lower correlations and more dispersion, it's a great platform.
So it sounds like you agree with what I hear from many, that it's going to be a much more tactical market this year, a stock picking market. And maybe it's because all of these other stocks outside the Mag 7, and I think you believe this too, are going to have such a nice bump in earnings growth that they're going to justify, in some respects, investing in them in ways that maybe they haven't been able to in the past.
Yeah, so I think that the shift away from such a hyper focus on the Mag 7 is a function of the direction of travel for aggregate earnings for that group. In level terms, if you were to take a snapshot and you would look at expectations for this quarter or even all 4 quarters of 2026, you are still looking at a higher growth rate for cohorts like the Mag 7 or tech or comm services relative to the other 493, other sectors. But it's the direction of travel that matters. So you're seeing a decelerating pace of earnings growth for many of those prior tech favorites and an accelerating pace of earnings growth in some of those other areas. So as I often say, the Scott better or worse often matters more than good or bad. So I think we have to look at direction, not just level. And I think that has been one of the supports. By the way, the rotation story is not a brand new story. It gets masked when you have a concentrated market like last year, or at least the first quarter, call it 3 quarters of last year. But, the S&P, the market was up 16% 27% last year. The average member within the S&P 500 had a 27% drawdown last year. The average member within the NASDAQ last year, and the NASDAQ did even better at the index level, but the average member within the NASDAQ had a maximum drawdown of more than 50%. That both suggests that there's a fuller story being told under the surface of the cap-weighted indexes, but it also establishes the backdrop for more opportunities because you've had that churn and those sort of rotating bear markets that have happened under the surface, providing that opportunity.